Hi, everyone. Thank you so much for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. I want to welcome you. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. A couple of notes for our attendees. You are muted, but we do encourage you to ask questions or leave comments using the chat box, and the presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. And we'll try to make sure someone reaches out to you after today's event to address that question. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Oh, just one guest. I'm sorry. My script says two guests. Sometimes we have two. We just have one guest today. Joe Dominick joined Snyder Financial Group as a wealth advisor in 2017. Joe's experience in the industry started as a financial advisor in 2007. He's worked on large teams throughout his career, focusing on comprehensive financial planning and investment management for individuals, high net worth families, business owners, and institutional clients. Joe is a Washington State native who graduated from the University of Washington in Seattle with a BA in Business Administration at the Michael G. Foster School of Business in 2002. In 2008, Joe earned the designation of Chartered Retirement Planning Counselor from the College for Financial Planning. And in 2019, Joe earned the designation of Accredited Portfolio Management Advisor, also from the College of Financial Planning. Joe is life, disability, variable life, and variable annuity licensed. And Joe, we've done a lot of preparation to make sure this presentation is interesting and engaging and also super educational, we hope, for our attendees. So I'm really excited to get started. I'm going to go ahead and turn over the time to you.
Thank you, Marcia. I do appreciate that introduction. Hello, everybody. Today, really what I wanted to do is cover financial planning and really a simulation. I've got an example that I'll share with you, but it's very important to understand the basics of how do you put together a financial plan, and have you ever done a financial plan, and what software are you using for financial planning? It's very critical to understand not only where you are now, but where do you want to get in your life journey of trying to someday replace your income. And we have a lot of good slides to share today, and we'll be interactive along the way. But the first thing I just wanted to throw out there to everybody is a question. Let's start with a question. What are some of those topics that are really on your mind as far as financial planning? And if you want to type that into the chat box, Marche can help kind of get that out on the table, if you will, for conversation purposes. But I just wanted to kind of get a feel for what are some of those hot topics, pain points, if you will, questions you have about financial planning. And then hopefully we can incorporate that today.
All right, we'll go ahead and move on, and I'll chime in once we start getting some answers.
Great, thanks, Marche. So the $1 million question, if you will, the biggest question out there is, are you gonna have enough in retirement? Will you have enough income? Will you be able to replace your income adequately per your goals? What do you want to do in retirement? Do you want to travel more? Have you thought about things like healthcare costs and everything else going on with your expenses in retirement? So the big question is, Have you saved enough, and are you able to replace your income someday? The most pressing question for most people contemplating retirement is just that. Now, is it possible to know the likelihood of success in that scenario? I would say yes, but there's a lot of things that you need to consider in putting together a financial plan that can describe what you need to do now potentially.
We're getting some comments in here. I just want to acknowledge some of
Yeah.
these. So a couple people put, yeah, how much do I need uh, how much do I need in order to retire?
Hmm.
Will I run out of money? Should I move into stocks that pay
Mhm.
dividends the closer I get to retirement? So a little
Mm.
more specific question.
Yeah.
Someone else put, um, should I plan on taking care of my elderly parents in retirement? So some really
Right.
good questions there. I don't have time to read them all, but keep them coming, guys.
Those are phenomenal questions. And the one thing that stands out right when I hear you mention those questions, Marche, is it's all unique to everybody's situation. Every financial plan is unique to the person asking those questions. So, good example is, will you have enough? And this is interesting because just a couple days ago, I was meeting with a client and they said, "Well, Joe, don't I need like $5 million to retire? Isn't that the number I need to hit? If I don't hit that, I'm not going to replace my income." Well, that's not the kind of nobody can answer that question unless they go through a very thorough process of understanding the entire landscape of your financial life, because your landscape is going to be different than the person next door down the street, right? And so financial planning and utilizing a software program that allows you to build out that environment and that landscape of your financial life is critical. And so we'll go through some of those items today that you can work with a financial advisor or a professional in data input, putting all the data inputs, the assumed variables, and actually on your screen right now kind of gets us to that point. So how do we get there in answering those kind of questions? The other question that I heard was, do I have a relative come and live with me? That needs to be a very critical part of the financial plan. Then we have to forecast what maybe the expenses would be around that decision. And how is it going to intertwine with some of your other financial goals as well? So great questions, by the way, to start off. So how do we get there? How do we put together a financial plan? And I always like to go back and say, without a plan, what do we really have, right? It's like a plane goes up in the air. The pilot doesn't have a destination, so they're just flying a plane. The same analogy is really for financial planning. If you don't know where you want to be, how do you know how much you have to save or how long you have to work or how much you're going to spend in retirement? So we have to really start with the end in mind and then back into a solution, if you will. So how do we get there? Your financial advisor will work with you, or at least you should be working with somebody if you can't do that on your own, to define what are your goals. Goals for now, goals for the next 5 years, goals for the 30-year vacation you could potentially take in retirement. Data about you and your family. So you should work with your advisor to communicate what exactly is your income, what are your assets, what are your liabilities? Do you have certain loans? Do you have a mortgage? What are all the specifics of each one of those liabilities as well and assets? What is your risk tolerance? And I'm going to get to this a little later, but what assumed variable, in other words, what rate of return are we going to use in planning? Should we use 8%, 10%, or how about chop that in half, make it 4 or 5? I would rather do the latter because there's nothing worse than presenting a plan using super high growth rates and they don't materialize. In other words, your plan doesn't come into effect. And then current and planned savings. So how much are you saving in your 401k now? How much are you saving in your cash account? Do you have adequate cash for maybe the first 6 months or a year of retirement in case we have a bad market event like a bear market, similar to what we're going through right now with the American economy? And then also planned retirement age. So are you shooting for age 55, 60, 65, 70? And how does that also intertwine with the decision around healthcare? So are you waiting until Medicare or are you going to buy your own healthcare plan maybe at the age of 60 and retire younger? Or does your employer give you a healthcare plan that runs you all the way up until Medicare? These are all the components that clear communication and collaboration with an advisor are going to help build out that plan, if you will. So you have to be very detailed, very specific. And then the last thing here on the page is life expectancy, mortality. Nobody wants to talk about death, right? But at the end of the day, we've got to at least extrapolate this plan to a certain degree, right? Are we going to use mortality for an average man or a woman in America? Or are we going to say, let's be even more conservative because of that communication with your advisor? Maybe mom and dad are in their late 90s. We should probably shoot for late 90s then for your plan, as opposed to mortality for an average man or woman in America. So as you can see, there's a lot of data inputs that have to go into this financial planning analysis to come out with some good results. So net worth statement. So what I want to do over the course of the remainder of our time together is really help present to you a example of a financial plan using a software program. And so I'm gonna share my screen in a second, but the first one that I want to show is a net worth statement. I look at a net worth statement as really kind of, it is the document that should be consistently updated with your financial advisor. It should be front and center every meeting that you have with an advisor, where you should talk about the nuts and the bolts of your financial life. It's your statement of financial position. I'm going to share my screen now, so bear with me here. Is it up on the screen? Here we go. Okay, so this is an example. And by the way, this household here with their net worth statement is not a real household. It's a fictitious client, if you will. So this data is, I don't know who Frank and Joanna Miller are, but that is who is on this page. You'll see their names scattered throughout the net worth statement. But this is a net worth statement or a statement of financial position that displays your financial life in total. So when you talk about assets and liabilities, if you drew a line down the middle, you've got assets on the left here and you've got liabilities on the right. So it's what you own versus what you owe. And at the bottom of the page, or even actually on the far top right, you're going to see a number called your total net worth. So if you took all of your assets and you subtracted or paid off your liabilities, what would you have remaining? And that includes not only your assets of a non-retirement variety, so think bank accounts or a non-qualified non-retirement type of account, even whole life policy cash value, if you will. Those are non-retirement assets. Then you've got, if you scroll down a little farther here, you've got retirement assets. I'm circling here with my cursor. Not sure if you can see that, but we've got
Yeah, I can see it.
qualified.
Okay.
Okay,
Yeah.
perfect. Then we've got qualified retirement accounts like a 401k at work, a 403b, Roth IRAs, any sort of a retirement account here, that's going to be also included on your net worth statement. And then you can total it by total liquid assets. So these are the assets that you have available for withdrawal in retirement during the distribution phase of retirement. So think accumulation. We'll get into this a little later as well in some more slides, but you've got your accumulation phase of life where you're saving money. And then when you get into retirement, you have what's called the distribution phase. These are the assets, the non-qualified, meaning non-retirement, cash alternatives, and non-retirement. And then you've got your retirement assets like 401ks, IRAs, and such. That does not include your real estate assets or your personal assets like automobiles or jewelry or anything. And the reason why I like to dissect these is because when you think about it, are you going to be chipping away part of your house to make payments someday? No. You are going to want to maintain that house, right? So unless you do other varieties of using your equity in your home, I would argue that that should not be included in the distribution phase of planning. It's more about what have you accumulated during your life, your non-retirement assets, your cash accounts, your retirement assets, and then we put together a distribution example for your life. On the right side, you've got the long-term liabilities, or short-term liabilities. So those are what you owe. You have a mortgage potentially. You have credit cards. You have a car loan. You have a variety of different kinds of loans. You need to pay those off over time. So when you subtract your liabilities from what you own, which are your assets, you get your total net worth dollar amount. One thing I will mention is that over the progression of your life, you want to try to see your net worth increase over time. That's a good barometer to use when you're talking with your financial advisor. For instance, maybe last year when you met with your advisor, you had $200,000 in net worth. The next year, Of course, considerations of the market environment and everything else in between. Let's say fast forward a couple of years, maybe now your net worth is 300,000, 400,000. Over the course of your life, your financial life, you want to try to see that in an upwards trajectory, right? It means you're doing something right. You're saving money as opposed to just taking on massive amounts of debt over time. So that's the net worth statement. And we'll go to the next slide here.
Joe, before you move on, I
Yeah,
did have a question here.
sure.
So for example, your home,
Mhm.
I see here that it's a joint investment, 850K.
Mhm.
And then we've got the mortgage on the home. So you're putting in like the current value of the home
Mhm.
less what you owe. Is that correct?
Well, on the left side would be the value that you think your home is worth.
Right.
So, based
Mm-hmm.
on either, one of the companies that tells you what your value is, or you could say this is what I think it should sell for in my community. On the right side is just the value or the balance of the remaining mortgage attached to that property. So I would say keep it current, right? So what the value you think of your home or this vacation property home as well is what the value you think it is worth. And then on the right side, if you have any liabilities or mortgages attached to those, that's where you want to separate the two. So it's not
Uh,
as though as though you've already subtracted it from the value on the left. You want the real value, what you could sell it for. And then on the right side, the liabilities is what your balance, what you owe on it.
all right. Thanks for clarifying that. And I think we can move
Absolutely.
on.
Perfect. So the other part of planning, when we go back to, well, what ingredients do you need to provide for a proper plan? It's the data inputs. And so some of those data inputs are defining what your income sources are now and in the future. So one of them being now is at your employer. What are you making at your employer? Do you have any other on the side part-time jobs or anything that you're earning income for now as you're working? And then fast forward into the future in retirement, of course, Social Security, that's one component. And you can always find the updated number of your Social Security on their website for Social Security. It's ssa.gov, Social Security Administration.gov, or I'm sure if you may have received some in the mail, but they actually kind of point you back to the website. If unless you're over age 50, you probably won't be getting those every single year on a consistent basis. So I would just go to the website and get an updated report, if you will, and then share that with your advisor, because your advisor is going to want to know what is your Social Security income going to be at age 62, the first year you can take it, your full retirement age, which could be anywhere from 65 to 67, and then also at age 70. Age 70 is the highest payout. The reason I say provide your advisor with all of the data on that report is because then you can run multiple scenarios and optimization strategies of figuring out, when should I take Social Security? When should my spouse take Social Security? As you can see, it gets a little more complex of just knowing your number at one age. So providing that detailed report to your advisor is critical in planning. And then the other is income, such as deferred income, meaning, do you have any pension money coming to you? Not all of us are blessed with a pension, right? They've kind of gone away over the years. There's a variety of companies still, a few companies still have them. But do you have any pension income? If you're a government employer or what have you, we need to know exactly what those details are as well. And then most importantly, from a standpoint of accumulation in your working years, you're going to want to know exactly what you are putting into those savings vehicles like IRAs and 401ks and Roth IRAs or 403bs or your cash accounts. How much are you saving on a consistent basis? That's one of the biggest factors in financial planning, is what are you doing now? Are you saving, and which bucket are you putting that money into on a consistent basis? And not only that, but what is your employer giving you? Do we know what your company matches? Do we know exactly what that formula is? And are you taking advantage of that company match? I'm going to share my screen again. So I'm going to go back and let's get it on the right page. Sorry. Okay. So for instance, this is a page in again, a sample version of a plan where it's going to show the income, salaries, bonuses. It's going to show Social Security for Frank and Joanna here. Again, fictitious people. And then your income deferred. So Joanna, as an example, has a hospital pension that's going to pay her $12,000 a year starting at age 65, and that's going to go all the way until the second death. So in other words, this probably had a survivorship benefit of 100% on it. It could be unique to any sort of a pension, right? But we've got the earnings potential right now. So what are each of them making at their job? And then what about in Social Security when that starts? And as you can see here, for this scenario, we're using age 65. So between the advisor and the client in this example, they chose to say, I think I want to retire at 65 and then I want to start taking Social Security right away. Okay, that's one scenario. You could have multiple scenarios. You could say, well, what if Joanna waits until 67 or 70? That would be a couple more scenarios. And then we can start to fine tune it to figure out what would be the optimization strategy and when you do decide to turn on that income source in retirement. At the very bottom here, you can see, and again, this is a sample plan where you can see how much are they saving in the different buckets of their financial life, right? The savings vehicles like the 401k, the 403b, a 529 plan they have. So college savings vehicles for their children in this example. How much are they saving per year? An example is Frank's 401k. He's putting in on the far right here 10% of his salary. And then the employer gives him a match of 100% up to 3%. Those are data points in planning that you've got to get right per your situation, because if you get that wrong, it could mean a difference of who knows how many thousands of dollars you might have exhibited in the plan at your retirement age. And I think we're good to go to the next page then.
All right.
Savings. So we were talking about savings, the accumulation phase versus the distribution phase. So think of it this way. When you're working, you're trying to accumulate, right? You're not taking money out of your 401k as you work. There's penalties for that. You got to be careful. This age 59 and a half, or if your employer allows for you to take money out earlier than that if you retire. So you've got to look at all the plan documents and talk with your advisor on whether or not that would make sense. But while you're working, during your working years, that's the accumulation phase of your life where you're trying to save to replace your income someday. So when you hit retirement, you've done what you needed to do along the way to try to build up assets to start distributing when you choose to retire. So I will again share my screen here because I want everybody to see an example of this in a planning fashion. So here we go. Now this savings page, so it really highlights not only from a kind of a graphical illustration, but also a year-by-year breakdown. And again, software programs are different, right? This just happens to be the software program that our firm uses in planning, and it's very robust, so you can add 100, 200 pages to the plan. I'm doing a very simplistic version for the purposes of this, this meeting. But the savings here, as you can see, you can clearly see here the accumulation phase. So year 2022 at the top, it shows their ages, how much they're saving per year, different categories like Frank's 401k, Joanna's 403b. On the right here is what the employer is giving them per year in a company match, an estimate based on their income that we've already put into the system or the software. When you go all the way down here to, you see these little icons here, that's when they're going to retire. So 2050, 2051 is their retirement. As you can see on the illustration here, they're not saving anymore. There's no more savings going in because that's when we're shutting it off, saying accumulation phase is done. They could still continue to potentially save maybe some surplus that they have every year if their income exceeds their expenses. But really, they're done saving. They say, this is when I'm going into retirement. I'm going to start distributing money in retirement. So sharing this example or this page, what I'm trying to highlight here is that this needs to be very understood by not only the client or the advisor, but are we clearly defining the timelines of when we are saving versus distributing money potentially? Or are we having saving going a little bit longer because maybe there might be a part-time job or something else into the mix? I like to really communicate this to a client so they understand this is truly when we're going to start turning on income to supplement your other guaranteed sources like Social Security.
And it's interesting there how they have two different retirement years. Can you talk a little bit about that? How, people are different ages and
Right.
one may be working full time, the other may be retiring.
Yeah, that's a great question, Marche. I would say, it's again going back to just the uniqueness of anybody's household or their situation. I'll give you an example. Family that we met with a couple of years ago. There's about an 8-year difference between husband and wife. And so because of that 8-year difference, the person that was younger wanted to continue to work. She wants to. She doesn't mean that they might not have to per the plan, but again, that's going to be unique to that planning situation. But because of that, she's planning on working about 5 more years after he retires because of their age difference, and she's very passionate, wants to still continue to work. But that's where when you factor that into the plan, there might still be that income and that savings element for a few more years in this savings example here. In this example, they're retiring pretty close, right? So again, that's very unique to everybody's situation. And maybe that's a talking point of running multiple scenarios per a unique situation, is saying, well, what if you did decide to retire at the same year, even though you have an age difference potentially, right? What does that do to your probability of success in the plan? Or the cash flow scenario, is there a year, and we're going to get to cash flow here in a moment, but is there a year where you run out of money, where all of a sudden on the far right of the cash flow, you go to zero?
Mm.
That's not a good situation, and we need to solve for that. So when we'll get into that, it's actually a really nice segue, because I think we're almost to that point here in the discussion.
Yeah, we're going to talk about, I believe, liabilities and expenses
Perfect.
next.
Perfect. So liabilities and expenses. I would say this is, I don't want to call it a wild card, but there are some wild card expenses in here that we're going to talk about today. But making sure that you can communicate with your advisor and in your family is really understanding to a very high degree, what kind of expenses do you have now? And what kind of expenses do you think you'll have in retirement? I always challenge clients, and my own family included, is to say, what is our budget now? What do we think is going to change in 10 years or 20 years, or when we are 65 or 70 or what have you? What are our goals that are going to change? And what are the obligations, if you will, in the future? What are the expenses that might be different in the future? So you can almost put together two budgets, especially if you're getting closer to retirement. Maybe you're 5 years out or 2 years out, and you're trying to figure out, how much am I going to really be spending when I get into retirement? So expenses could be recurring expenses, right? Living expenses. They could be your water, sewer, garbage, your gas, your groceries, your restaurant expenses. All those are all living expenses. But then you've got your liability expenses, your outstanding debt obligations. Remember, on the right side of the balance sheet or your statement of financial position, your net worth statement, it's got your credit cards, your liabilities, your mortgage. Those are your outstanding debts. You've got to service those debts, whether or not you're going to pay them off or try to by retirement, or what does the plan dictate is acceptable in allowing for a high probability of success. So that's where you can run multiple scenarios of saying, what if we try to pay off the mortgage by retirement versus cash flowing it into retirement potentially? But you need to understand what your expenses are now and then what they may look like in the future. And that conversation can really be had with an advisor that runs really comprehensive plans. The wild card in planning that I commonly see is healthcare, where there's a lot of people that say, hey, Joe, I want to retire at 50. And I say, okay, that sounds great. But what are you going to do for the 15 years until Medicare? Medicare doesn't start until 65. It doesn't start at 64 or 60 or 55 or anything like that. It starts at 65. So Medicare comes into play at 65. So if you want to retire younger, you have to have a plan of what that healthcare cost may be for your family. So if you have children still, and maybe you're 50, but you want to retire younger, or does your employer allow you to maybe have, obviously you've got the COBRA plan that you can do for about 18 months or so. And then you may have to go out into the market and buy your own healthcare plan. That could be a lot of money. It might change over the next year or 5 years or 10 years, but we know today pretty much what those kind of averages may look like. It's all going to be dependent on where you are, obviously, what county you live in, things like that, what provider you might choose to go to. But building that healthcare cost into a plan is critical. I want to show you an example here in the plan. So let's go back to the plan that I'm showing you, the sample plan. I think we're up now. Okay. So this is a page where it's going to highlight all of the liabilities and expenses. So all the summary of expenses for this family, if you will. I'm going to scroll down. You can see at the very top, there's one of those liabilities that we highlighted on that net worth statement, your mortgage. So they happen to have a mortgage here. It's got an original loan amount of 600,000. The balance right now is 426,000, you can see. And then it's a 20-year term. It shows the estimated payment here. And that's one expense, right? So we know that's going to be factored into the cash flow we're going to share with you in a moment. And then we've got a loan, a credit card. So they've got a balance here. We estimated about 120 more payments on that credit card. Estimated payment is about $54 a month. That's going to be a conversation point year to year. Has that ballooned up? Are they making headway on it? Did they make any extra payments? Can we shorten that amortization of that loan potentially over a certain time frame? And then you get to your living expenses. These living expenses, actually, I'm going to come back to the living expenses in a second. I'm going to go down to the other expenses below. But you've got expenses for education, maybe for your children, right? College costs and all that. They happen to have 2 children, Lucas and Mary Beth. So we forecasted what that cost may be at a certain type of college, right? Maybe they're looking in state or out of state. And so good software programs will be able to pull a lot of that current information into the system. I could go right now into our system. I could say, let's just throw one out there, University of Arkansas or University of Texas or some school in Washington State, and it will tell us the going rate for those schools, and it will bring it into the modeling, and it will allow you to put a certain cost of living adjustment on it as well. So you can put 4%, 6%, 8% cost of living. And those are some of the assumed variables that you want to work with an advisor to make sure you're being conservative in those different assumed variables like cost of living or inflation on different types of expenses. So going farther down here, so we talked about college expenses, but then there's also other expenses. The two that, or the one that I would say is really a wild card, are healthcare. Here's what I build into every single plan that we do here at our firm is we build in a retirement medical / Medicare expense cost. There's a lot of studies out there that indicate that the average American on the average at age 65 is going to pay outside of Medicare, whether or not you buy a Medicare supplemental plan or if you're paying for vision and dental and copays and prescription drugs and deductibles and all that lumped into one. The average American spends around $5,000 to $6,000 a year. Could be more, could be less. That's just an average. And then the cost of living adjustment on that is about 6%. So not your typical inflation number. Healthcare, that's why this is a wild card expense that you've got to get a little more dialed in with in your plan. You don't want to just leave this expense out and then you're 75 years old and you never accounted for it, and all of a sudden your plan tips over and you run out of money because you didn't account for this major, that what could be a major potential cost in retirement. Of course, these costs may change as you get into retirement and you work within your advisor. The financial plan is a living, breathing document. You have to update this plan as you go, right? The moment you hand it over to somebody, guess what? Asset values have changed, the market's changed, certain portfolios. So you got to get updated as you go with your advisor. But going back up to the living expenses, the living expenses are everything outside of any categorical expenses that you see on this page. So any loans, any mortgages, any education expenses, any retirement medical expenses. Living expenses is everything else. Think food, restaurants, gas, water, sewer, garbage, birthday presents, vacations. You could actually identify vacations and you could put it as an other expense and say every year I want to spend $10,000 on vacations with a certain cost of living adjustment. The point of what I'm trying to share with you all is that you've got to be dialed in with your advisor that you're working with, or if you're doing this on your own, you have to get very granular on the details of each expense. In other words, cost of living adjustment. It's not the same for healthcare as it is for maybe, I don't know, well, in this time, gasoline or healthcare, or I'm sorry, food or restaurants or what have you. You want to make sure that you're being more conservative in those increases over the years. So everything that we just talked about, all the data points, right? And we've got data points that started off with your income, any savings that you're doing, the liabilities, the expenses, when do you want to retire? How long do you think you'll live potentially? Mortality. And we're going to talk about that on this page as well. So do you want us to run it to 100 years old or 85 or 80, or maybe nobody in your family's made it over 91, so you choose to put 92, right? That's mortality. But cash flow is when you put all these ingredients into a simulation, into a software program, you stir it up and you get output, right? You get output and it's going to show you in a linear fashion. So linear, meaning that this is just whoever the advisor is or the team who's putting this together, it is using a constant rate of return over time. And this is why I would say we need to be very conservative. And we'll talk about some of those rates of return, if you will. I'm going to share my screen here in a second. But this is a linear model because this is not randomized by a computer. It's just using the data points that are produced by the advisor with the client saying, let's just use a low rate of return. Here's how long I think I'll live. And here's all the data that we put into it. It's not randomized. So let me share my screen here. Okay. So as you can see here, this is a cash flow scenario. Again, and you can run multiple scenarios. You could say one of these scenarios, I'm retiring at 65, one I'm retiring at 67, one I'm 70, one I'm taking Social Security at 70, one I'm taking Social Security at 62, onward, right? And so here's a cash flow example. You've got this graphical illustration on the top, inflows and outflows over time. You've got portfolio assets on the right. Do you run out of money? Well, let's look at it year by year. And I think this is the best way to look at it is starting right now. We're in year 2022. Frank and Joanna Miller, 37 and 36 years of age. They make $350,000 a year. They've got total expenses. It shows here total outflows. By the way, in the system, you can have any surplus income just spent in the plan. That's a conservative way to run any plan. Is some advisors will have the money being, saved. If you have an extra 5,000 of your income over your expenses one year, they'll save it in some non-retirement account, earning 4%, 5%. I think the more conservative way to run planning is to just clear that out. Human behavior, right? You got an extra $5,000 one year. What do you think you're going to do? Put it in your bank and say, I'm not touching it? Or are you going to take a vacation, do a home improvement project, pay down some debt? So I like to just have the mindset of saying it's going out. It's going out, unless it's just a major amount of money where you can actually start picking and choosing what you want to do with it. But in a lot of the plans that we run, we just like to spend that money end of the year. If you have any surplus, just let it evaporate from the plan and say it's spent, right? But so in this example, you can see on the far right, I want to draw your attention to the far right. There's a lot of different categories here. We could go through each category for probably a whole nother, scenario here, or time spent with each other. But on the far right, you've got total portfolio assets, which are only the investable assets, meaning what do you have in your bank account? What do you have in your non-retirement accounts? What do you have in your retirement accounts? Not the value of your home. It's the money that you would potentially turn on for income in retirement. So that's the key part of this cash flow, is that on the far right, total portfolio assets includes your liquid assets. What is available for retirement withdrawals? When you go all the way down again to those little icons down here of retirement years for Frank and Joanna Miller, you look over to the right, wow, they've accumulated a lot of money. This might not be the best example to use because they actually end up with a lot of money, right? Some people don't at retirement. But for Frank and Joanna Miller, they end up with a lot of investable assets at their ages of 65 years old. So when you scroll all the way down to the bottom, is there any year where they go zero? Yes, there is. So when they hit age 91 and 90 years old, they tip the scales. They run out of money. Their liquid assets are gone. They spent all that money over the years. Because of all the expenses we built in, they actually spent all their money. So now they're down to age 91 years old and 90. What are their options? Well, they're homeowners. They have a home. So maybe they need to actually do some sort of they're going to sell their home and downsize. Maybe they have to sell their home at that point in time. This is where an advisory firm can really come in and help analyze their situation and provide recommendations and options during their life, right? Because maybe there's something that they can do ahead of time to avoid running out of money. That's really the biggest question in planning is, are you successful in your linear approach, the cash flow model that you and your advisor put together? And then are you successful in the Monte Carlo? We're going to get to Monte Carlo in a second, where it's randomized by a computer, 1,000 different iterations. How many times do you come out with $1 remaining? We're going to jump to that in a moment. But in this scenario for Frank and Joanna Miller, this fictitious client, if you will, they run out of money. So unless they don't make it to 91 and 90, they are basically, they're going to dissolve all their assets, their liquid assets. They're going to need to make changes, probably sell their home, probably downsize, whatever it's going to take, fully preparing up beforehand, right? That's where the advisory firm can really add value to their situation in doing planning. So that's the cash flow. That's the version of just an advisor and the client putting it together and using variables and using the data points that the client has brought to the attention of the advisor. Let's go to the randomization. I want to go to the next page here. And before
Before
that,
you do
Marche,
that,
yeah, go
before
ahead.
you do that, can you scroll down? And we just had a question here about,
Yes.
okay, actually go back up to the top.
Yep.
So can you talk a little bit about those red numbers in the beginning of the scenario here, this
Right.
net cash flow? Can you talk a little bit about why they're red there?
Yes, and so each year there's going to be, well, you can see on the far left, income flows, right? So this is the income that is being brought into the plan based on, maybe there's a cost of living increase on their wages of inflation, right? So you're seeing income going up over time. When they hit 65 years old, you can see, oh, the income drops, because now the only income they're getting is Social Security at that point. They're retired. So the income goes down. So now you can see on the right, and I'll go back up to the top as well, but now you can see, in order for this household to replace their income or meet their expense objectives by the year, they're going to have to take out money from those buckets that they've accumulated over time. Their non-retirement assets, their bank account assets, their retirement assets. That's why you see red, is because those are the withdrawals they need to make, or distributions in retirement. Up above here, when we scroll back up, by the year, they must have had some expenses here that also force them to tap into some savings for some of their expenses in their plan. So, and that's where you can get very granular, very detailed with an advisor. Literally, I could produce a report that only highlighted that net cash flow column, where we can go and dive deeply into it and say, okay, well, here's the situation. This one year, you're going to have to start withdrawing money from some bucket of money. That's a very good conversation to have with an advisor, because guess what? There's a proper and prudent methodology that you should employ. You probably don't want to touch your IRAs at that point, because you're going to get slapped with a 10% penalty under age 59 and a half to start using that bucket of money for these goals that when you're in your 30s and 40s, you don't want to touch that account. So maybe the only account that you should be withdrawing from is your bank accounts and your non-retirement accounts, if that makes sense. And so the conversations can be really, really good for a household when you are faced with a challenge. Maybe there is a deficit one year, and that's why you see red here. So the system, the simulation here, the software program is saying, hey, we're short some of these years, so we have to start withdrawing money from the appropriate bucket. The one thing that, or the appropriate account, I should say, the one thing I will say is that you can set up the software programs. That's what we do. We set up the software programs for the proper sequence of withdrawal, meaning which account should we take money from first? What makes most sense, right? And then, of course, if it does have to tap into another account that doesn't make sense right now, is behind the scenes, these software programs are very, very, very intelligent. And so it will actually pull in data from your state, any taxes, the federal taxes, all those considerations are being done behind the scenes in the planning, if you will. And there's a lot of reports that you can run also on different software to show you what the tax implications would be. So I hope that makes sense. I hope that answers the question. But the red is literally just withdrawals coming out of those different accounts.
All right, thank you so much. Did you want to go to another portion of this before we go to the Monte Carlo simulation?
Um, I don't think so on this page. I could literally spend probably an hour on each column. So I think it's probably best that we, from a high level, this is where you do want to get granular with an advisor, where you are talking about each different column. And good question about the net cash flow. Why is it red? That should be an entire meeting with an advisor as you get to know that, or the advisor gets to know your situation. So great question though. Monte Carlo simulation. So every planning software should have a Monte Carlo simulation built within the constructs of the plan. And why I say that is because what I just showed you was a linear version. That is Joe's data, the client's data. It's Joe's assumed variables, the client's assumed variables. It's agreed upon for the planning, saying, what rate of return do we want to use for planning? Do we want to use a low rate of return, a high rate of return? Do we want to use, a 5%, 6%, 8%, 4%? You want to be conservative. And so when you run a linear version, the cash flow simulation that I just shared, that's all. It's not randomized. It's all put in there by the advisor and the client, and it's static. So every year you're getting, 4% on the average for your growth on the money, if you will, or of those accounts. Monte Carlo simulation is the computer stress testing your entire plan 1,000 times over. So think of that cash flow being done 1,000 times by a computer stress testing, randomizing results. Here's one of those 1,000. The year you retire, we have a bear market. The market goes down 30%. Think March of 2020 and a few years ago, the market goes down 34% in the month of March. That would be one example of those 1,000 different iterations of the plan. There's 999 more that are going to be performed behind the scenes in this planning software, where maybe another one is 10 years into your plan, we have a great recession. It's a 3-year long, maybe 18-month long recession, and your account goes down by 25% during that time. That's 2 of the 1,000 scenarios. So there's 998 more. And what the Monte Carlo simulation does is it provides you with a number called probability of success. It's a percentage. And is your percent high? Is it low? Is it 100%? Is it 80%? Is it 20%? Personally, and from our firm, we want to try to strive for at least 80% plus. I don't feel comfortable for my clients if they're at 61% probability of success. To me, that's not really getting you home. There's a lot of risk with that maybe, even though you might feel good about what your assets are, there must be some disconnect between spending and income coming in during your planning scenario, where we might be able to help identify a gap. The Monte Carlo simulation really helps put it into a context of saying, let's randomize all those different types of scenarios, and let's show you how many times out of that randomization, how many times you are successful. So I'll go to a slide here that will share with you some of the output that you should expect in planning. Let me just go and here we go. Let me share my screen. And it's going to take a second because the computer is actually behind the scenes running the Monte. Here we go. So Monte Carlo. So Frank and Joanna Miller, this fictitious client, if you will, look at their probability of success, 40%. We already saw it on the linear cash flow where it was they ran out of money at age 91. So to me, just having seen that, I already know that their Monte Carlo probability of success is more than likely going to be pretty low. So this is a low number. This actually tells me we've got some more conversations to have, right? We've got to build out a plan, another scenario per se, of how do we help solve for any sort of a gap. They clearly had a gap. They don't make it to their desired mortality of 100 years old. Now, if we would have started by saying they only live to 90, they're good. They're good. They don't run out of money, right? Or maybe they run out of, maybe their Monte Carlo is 85%, and we're looking really good on paper. But again, running things conservatively is the way to go, because what happens if you do live to 95? What happens if you do live to 100 because of the advancements in medicines and everything else, right? So here we are. Probability of success for the Frank and Joanna Miller is 40%. There's different, I would call them different levels of returns. There's different upside scenarios, median scenarios, downside scenarios. What I always like to say is when you see all of these results out of 1,000 scenarios, you don't really want to look at the upside. What if it was a perfect market the entire time? There's no way that Frank and Joanna Miller are going to pass away with $15.57 million, right? But that's the top percentile of those 1,000 different iterations are suggesting that, well, if you're in the 97 percentile of positive returns, you're going to die with $15 million. Not going to happen. We already know that, right? It'd be a miracle if that happened. The downside is also probably not going to happen. That's the bottom 2% of those iterations, the results, if you will. They're probably not going to die with minus 13 million. It's probably somewhere in the median range, median to upside range. And so when we go, if we went to go back to the linear version, the cash flow, they're actually very similar. The median returns of minus 3.8 million. In other words, they ran out of money in their early 90s. But I always like to see where that is as far as, are they somewhere in the realms of the median output? Usually the cash flow, if you run it conservatively, they're going to be pretty close as far as their results. So Monte Carlo is a very good, helpful indicator of how well are you positioned to replace your income someday in retirement. If you've got a low number, there's got to be discussions had with your advisor of helping you solve a gap in replacing your income someday. So you've got the cash flow, and then you've got the Monte Carlo probability of success, two amazing tools that can help you define where you are in replacing your income someday. On the next page, we're actually going to talk about another part of the planning that I like to always incorporate, because a lot of these software programs are going to have a different way to solve for what you need to do to solve a gap. In other words, if you run out of money at 90, is there anything you can do at the age of 40 or 50 or 60, or you're 5 years away from retirement per se, to try to close that gap? So it sounds really corny, but here's the 3 ways. You either work longer, you save more, or you spend less, or maybe you get a windfall inheritance, or you win the lotto, right? I didn't put the 4th one on the slide because that rarely happens, right? You usually don't win the lotto or get some out of nowhere windfall inheritance, right? Sometimes some people do. But if you have a gap in your plan saying that you run out of money before mortality, you've got to solve for it. And there's really only a few ways to solve for any sort of a gap in your plan. And sitting down with your advisor, maybe another scenario is having you work a couple more years. Instead of 60, you work till 62, or instead of 65, you work till 68. Or maybe you just need to crank it up a notch on your contributions into your 401k, go back to your budget and figure out, laser focus on a few expenses that you really don't need to have anymore, but you need to crank up your savings in your 401k. Maybe that solves the problem by increasing it by 2 to 5% in your 401k. Or you need to change your lifestyle in retirement. Maybe instead of spending 100,000, you spend 90,000. That might solve the problem. That might solve the problem just right there by saying, I could probably shave off a little bit of my expenses in retirement, and boom, your plan looks great again. And that's why this is so critical to work with an advisory firm, unless you can do it on your own, is to identify what are some of the options that I have to try to, if you have a gap, to close those gaps while you're younger in your accumulation phase, when you still have time. Time is the most essential, important element of this whole process. So work longer, save more, spend less, and then you can parlay that into a plan to run multiple scenarios. So let's go back to Frank and Joanna Miller. Let's say they run out of money in the cash flow at 90 years old. But if I went back in another scenario and plugged in, they're going to retire now Frank's going to wait until 67, and he's going to turn on his Social Security when he's 67. He's going to delay for 2 years and work for 2 years more. And he's going to take his contributions as 401k from 8% to 12%. That might right there solve for their gap. Or maybe it's Joanna, they both decide to work 2 more years. All of a sudden, oh, the cash flow goes all the way to age 100, and they still have money remaining. Now they're leaving a death benefit to maybe their children or a charity. So working with an advisory firm to employ that kind of a process and having those conversations and looking under the hood per se of saying, what are you spending your money on? How come you're not maxing out your 401k, but I see these expenses over here, where are those really necessary, right? Having the hard conversations of trying to figure out how can we get you to incrementally grow your contributions over time is critical. especially if you're getting pay raises and your income's going up over time. You've got to pay yourself first and continue to try to, increase your contributions over time. So that usually helps solve for a lot of it if you catch it early. Not when you're 2 years away from retirement. That's when it gets very difficult to solve for that time frame, if you will. So Monte Carlo, cash flow, this all comes into play in identifying those options per se. And let me actually go to this page. I'm going to share my screen here real quick, Marche. And here's an example. So here is an example of what Frank and Joanna Miller, again, fictitious clients, could do. This is where the software program that we employ is solving for it. It's literally saying for your living expenses, or Frank and Joanna Miller's living expenses, they either need to save more for retirement, they need to retire later, or they need to spend less. And it actually gives you a spending range and everything. So save more before you retire. It says they would need to save an additional $3,500 per month, or $43,000 per year through 2049, the year before retirement starts, assuming these new funds will grow at about 4%, 3.97%. Many software programs, what you have to do, you have to realize in software programs is that if you put a custom performance or a growth rate number in there, it won't randomize the results in the Monte Carlo. So you have to use some type of a model that is produced in that software program. In this case, it's 3.97. I try to get it somewhere near 4% or so when I'm running the projections. And so that's why it says kind of this weird 3.97%, and it floats. So literally, because of this market environment, 2 months ago, it was 4.17%. Now, because of what the market's done, it does a 30-year, 50-year look back on certain indexes, and it pulls in that number using a conservative growth rate number. So they would need to save literally another $43,000 a year and have it hopefully grow by about 4% to meet their goal of not running out of money. Or they could retire later. It says here that Frank, he wants to retire at 65, but he might actually have to work till 71. And Joanna would have to work till 70. That would actually leave them money at the end of their life. In other words, they would make it to mortality, or they need to adjust their spending level in retirement. Their range, it goes from 140,000 a year down to 107,000, and they would actually still have money at the end of life, more than likely, right? There's always things that could come up that could derail this. That's why it's a living, breathing document. It needs to be reinforced and refreshed with your advisor every year, or as life changes, I should say. So that is the page that really does define what are some of those options that you can do in closing that gap that you might have. And hopefully you catch it way earlier than, oh my goodness, I'm retiring next year. I didn't even know it, but I run out of money in my 90s based on these projections, right? So it's always good to work with a team that can employ these processes.
And I just a question here, and I'm assuming that these are just 3 solutions, and there could be a combo of all 3 of these or 2 of them
Yep.
to make it work for this couple.
Thank you so much, Marche. That is absolutely correct. Because when you think about, okay, you've got options, but what if you did a little bit of each? What if Frank decided to work for 2 more years? Joanna, she's done. She doesn't want to work anymore. They decide not to. And so Frank works a few more years, and then they increase their contributions by 1 or 2%. And they decide to cut out a certain expense in retirement. And hey, we're just not going to be able to spend 20,000 on vacations every year. That's just an example. But maybe they take it down to 7,000 a year. Does that solve, using all those different cost of living adjustments and everything? Again, all those data points, all those assumed variables into the plan. Does that solve for it? Maybe it does. I bet you it would. It probably would. I've done enough of these plans that I would say a combination of those different changes usually will produce a positive result. But that's all about a conversation, right? You have to have that conversation and see what it does when you put in all those ingredients and you mix it up and it comes out with a different result, right? So you've got different scenarios per se. And now we're talking about really incremental changes that could really produce favorable results for a unique plan. Thank you, Marche. That was actually a very, very good question. So Marche's got the growth rate summary on here. I just want to highlight this. I truly, truly believe this for planning. And I've seen far too many plans in my career going back 16, 17 years now, where I've seen certain advisory firms employ a very high rate of return, low inflation numbers. essentially, and I'm not saying that they're doing that on purpose, but it paints a really rosy picture for clients where when they walk out, they go, wow, I'm going to retire. I can retire young even, but they're using 8 to 10% returns for the growth on the money. And I'm going, that's ridiculous, because what if you don't get 8%? What if we go through a prolonged recession or something happens, before retirement, and you're only averaging 4%, 5%, 6%? I would rather chop that 8% right in half and make it 4%, somewhere around 4%. Some advisors use 5%, but I don't think it's a good way to run plans when you're trying to just paint a rosy picture. I think it's more about letting the picture paint itself and then backing into those options that we just described and solving for any gaps that you might have using conservative variables. It's the key to planning, using conservative variables. Kind of summarizing, getting more detailed, right? So I think all of us, myself included, could get more dialed in, more detailed to what's to come. What's the vision for the next 5 years, 10 years, 20 years? Like jokingly call retirement your 30-year vacation potentially, right? How are you preparing for that 30-year vacation? Are you going to hit your bogey, if you will, right? And so getting more detailed, there's a lot of tools that you could use to find out where you are right now in relation to where that might look, what that might look like in 20 or 30 years. And a financial plan really does need to be a living, breathing document. It should change with your life as it changes. So when you decide, when maybe your children decide, I want to go to an Ivy League school, okay, that needs to be a very pivotal conversation in financial planning. Are you going to help your children pay for that Ivy League education? And what does that do to your plan? That's where plans need to be dynamic. They need to be massaged. They need to be talked about. It's not just a one and done. We did it 5 years ago and I'm good to go. Things change, right? All the data inputs change. A good example is somebody that might have wanted to retire a year ago. And then now we're, 10, 11 months into a bear market this year. Things have changed dramatically for somebody that might have wanted to retire this year versus next year. And so you've got to rerun the plan with the current data of the values of your different assets as of right now, as opposed to 1 year ago, 2 years ago, 3 years ago. And so constantly updating those plans is critical. So I guess the question to everybody is, do you have a plan? And you could look at this to anything in your life, right? Do you have a plan for what is the next step for especially your financial plan? So plans are very powerful tools. I think it's a starting point in discovery to figure out how well are you structured for eventual replacement of your income. And they identify a lot of problems before it's too late, right? Before that you're 3 years into retirement, you're saying, boy, I wish I would have done a plan, because this money is really like, I thought I'd get 8% returns and I'm not getting it. And so why didn't we use conservative variables to start? Now, at least you might feel more comfortable going to retirement using conservative variables, but it helps you identify what you might be able to do now as opposed to it's too late. Then, of course, a financial advisor can help you and keep you on track with your plan. It's really about keeping each other accountable, right? It's like, if you think you're on pace, you might want to just check in with somebody else to make sure, did you do it right? Did you use the right assumed variables? Did you use the right inflation rate for certain expenses like healthcare versus food? And so it's a good thing to check in with the advisor on that on a regular basis. And then it really doesn't just include your finances. It includes all the goals and the changes and the life events that happen along the way. And so your goals are going to change. You might decide that you want to be charitable at some stage in your financial life. Well, there's estate planning techniques you can put into your financial plan. I want to spend all my money, or I want to leave it to a charity, or I want to start gifting strategies every year to my 2 or 3 children, or what have you. Those are all different scenarios that should be unfolded with your advisor.
All right, well, we are almost out of time. I think we've gone a little bit over, but if you don't mind, I have a couple questions here that I want to address, at least a couple of these.
Absolutely.
And then I will tell our attendees, if you have a question, we're not able to get to it, go ahead and leave your contact information in the chat, and we'll see if we can reach out to you after today's event. All right, so here's a good question. Going back to that one about, this is a good question. Who manages your 401k or 403b once you retire? Can you talk a little bit about that?
Absolutely. So your 401k, your 403b, or whatever your retirement plan, right? There's 457s, 403bs, the whole gamut. Um, it's at a custodian. It's at a institution that your HR, your investment committee at your work chose to custody the assets. So think of some of those big names. I won't name the names, but there's some big names out there that you have to log in and you can look at your balances and make investment changes and all that. But you've got a choice at retirement. Your choice is you could either leave it at that custodian or at that institution, and potentially you could leave it in the 401k or the 403b, or you could roll that out into an IRA that's called an individual retirement account, where now instead of your certain amount of choices of mutual funds or exchange traded funds or whatever that those options are in your 401k or retirement plan, you've got the universe of funds to choose from outside of the plan, because most plans aren't going to give you you can just do whatever you want. You can go out there and buy whatever investments you want. Outside of that, you're going to give yourself more options. I'm not here to tell you that's the right answer for you, but I think it's worth exploring what your opportunities are. So if you can pick up that money, roll it out into an IRA. If you want to work with an advisory team, then you can work with an advisory team to help you put together the right assortment of investments using the universe of funds, if you will. Especially if they're acting in a fiduciary capacity, meaning they're not stuck with only a certain amount of funds because they work for an institution that owns their own products per se. They can go out and they can say what's best for you. We're not hamstrung by any sort of a company or what have you. But I think that's where you have those options. You can go outside the plan. You can leave it in the plan. Here's the third choice. I don't recommend this to anybody, but you could take all that money and send it to your bank account too if you really wanted to. But let's just think about that. The tax implications are going to be magnificent. It's not going to be a great experience that year if you decide to just blow up your 401k and send it to your bank account. You're going to pay Uncle Sam a lot of taxes. So you got to be very careful about those decisions. And a lot of the plan documents are going to dictate a lot of those options, by the way. So understanding your plan documents at your employer and putting that in front of your advisor and saying, let's understand it together, because your advisor might see something that maybe you didn't see.
All right, here's another question. Can you talk about the strategy of moving into stocks that pay dividends? And just maybe the asset allocation question about as you move into the distribution phase.
That's a beautiful question. I would say, during your accumulation phase, let's say you're 20, 30, 40, 50, what have you, there needs to be some conversation, maybe not as you're super young, but as you're starting to approach the finish line. Let's say you're 10 years away from retirement, 5 years, maybe it's 15 years, based on the conversation you're having with your advisor and some of their feedback, is we need to start having a conversation around a risk reduction methodology. And not only that, but maybe shifting assets like you had mentioned, Marche, maybe into some more dividend focused value kind of stocks, if you will, or maybe there's an exchange traded fund that has they're paying a very high dividend, if you will, because they are incorporating a lot of dividend paying stocks in that type of a product, if you will, called an exchange traded fund, or a mutual fund is another example. But that conversation needs to be had, and that needs to be incorporated into your plan as well, of saying, as you approach your finish line, your retirement age, should you still be driving the fast moving race car? In other words, should you still be super aggressive 100% stock? I would argue for most people, no, you should not. Because what happens in times when you're about to retire and then all of a sudden a bear market, a recession happens? It would probably be a lot better to start dialing that back a little bit as you approach the finish line, becoming more conservatively postured, because then you won't be as volatile, if you will, as you approach the end date of when you're done working. So having that conversation with an advisor, or if you employ your own strategy of a risk reduction methodology, is critical in financial planning.
All
That's a
right.
great
Well,
question.
yeah, it was a great question. And I do want to thank you. We don't have any more time for questions, but I do want to thank our participants for being here. And I want to thank Joe for providing such an educational presentation today. We want to thank the organizations that have made this webinar possible today. To our attendees, look for an email with a link to the replay of this event, and you're welcome to share that with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Thank you, everybody.